Hey, Highland County Real Estate, Randy Butler here, and I am at Lewis Financial with Chris Lewis,
Hey.
CPA. You just told me that you have been here 25 years.
25 years.
That's awesome.
October of
Awesome.
1993.
What I thought we'd do this time of year, 1st of January, it's not an exciting topic, but it's something we all have to do, and that's pay our taxes.
Yep, unfortunately.
Pay our taxes. Now, myself, I'm self-employed. I don't have the luxury of getting a refund like a lot of people.
Yeah.
I wish I did, but I don't. Kind of explain a little bit, like, you and I talked a little bit before about what you can deduct and what you can deduct, and you told me something I did not know, how the laws have kind of changed quite a bit.
Yeah, been doing taxes 25 years on my own, and probably my 32nd or 33rd year of doing taxes overall.
Mm-hmm.
The new tax laws that are coming into play now, probably more changes now than I've seen in 30 plus years of doing taxes.
Mm-hmm.
And most of them are good. I think most of them will be good for most taxpayers out there.
Sure.
In the past, a lot of people, they call, want to know what kind of things they can write off, what can I itemize. And the new tax law is really going to simplify things for a lot of people, because a lot of people that have itemized in the past may not be itemizing any longer. We've been doing in the past, we would automatically write off mortgage interest, real estate taxes, donation, that type of thing as an individual taxpayer. And in the past, if you had more than 10 or 11,000 in itemized deductions, it helped you on your taxes. Part of the new tax law, if you're married filing jointly, the government is saying, look, rather than itemizing, we'll give you $24,000 off of your income if you just take the standard short form and not itemize any deductions. So what we're going to see, especially in the Highland County area, you're going to see a lot of people that may be itemized in the past may not need to itemize. It might actually be better for them not to itemize, because, in the past, if your mortgage interest and your real estate taxes and your tithing to the church and all that was more than $10,000, $11,000, it made sense to itemize. Now, if those three major items are not more than 24,000, you're better off to just take this. The government's going to say, look, we're going to reduce your income tax-wise by 24,000.
That's awesome.
Just
that's
do the
better.
straight form and go with that.
The only bad thing that I see about that, Chris, is if there are any people out there like me, I usually spend one whole day a year taking that big box out of the attic and unfolding all the receipts, why I fold the receipts. That is so stupid. I never realized how dumb that is till you have to unfold them and then count them all and
Hopefully
everything.
read them
We don't have to do that.
Yeah.
That's awesome.
Yeah.
Okay, great. Here's another question. Let's say you are self-employed like me.
Yeah.
Just what are some of the things to look for? Because we will still itemize, right?
Yeah,
if you don't pay.
Yeah, the 24,000, that is in place for everybody. If you're married jointly, if you're single, that dollar figure is 12,000. If you're a head of household, single parent head of household, it's going to be 18,000. That's for the person that goes in, punches the clock, does a job, gets a W-2, and that's all they have to worry about on the tax side of it. A lot of people like yourself are self-employed. You're not only going to take your $24,000 standard deduction on the personal side, but you have to sit down and tally up your income and expenses from your business. And some of the items that you'll write off, for instance, you've been a real estate professional, you're going to write off mileage while you're out showing homes and doing research for marketing. You're going to write off office expenses, cell phone, business calls, any office expenses, basically anything that's tied to your business. Now, the IRS has something they call ordinary and necessary business expenses. And that's, basically you're making the argument that, hey, these expenses help me do my business, help me generate my income. So if the expense is tied into your business and, it does help you do your job, more than likely it's going to be a qualified business expense. Now, I've had arguments with the IRS in the past doing audits where they'll say, well, yeah, he did have an expense, but was it really ordinary, necessary business expenses? So I had an audit last year where, a big thing on the real estate side of it is you guys at a closing may give a client a closing gift. Well, I had an argument with the auditor saying, well, yeah, that was an expense, but was it really necessary?
Right.
That part of the gray area that we'll probably
Sure.
have to interpret and fight. So
So even self-employed people still get the 24,000.
yeah. You get the 24,000 off of your personal income,
Right.
and then we still have to calculate your business income and expenses.
So we still have to go through the box.
Still have to go through the
have to
box.
go through the box.
Unfortunately,
We
Randy, you
can
still
do
have to
that.
break out the box every year. So.
Okay, great. Hey, I'm here at Lewis Accounting. Chris Lewis here, very good at what he does. I've used him myself for several years. So I hope that's been of somewhat information to the folks at Highland County. And if I can ever help you at any real estate needs, please feel free to contact me at any time. Thank you very much.
Thank
Chris.
you, Randy.